Do you wonder about index funds versus mutual funds? I'm going to share with you in this video what the difference is between the two. Hi, I'm Camille Gaines, founder of FinancialWoman.com and author of Earn, Grow, Give, a personal finance book for women. But most importantly, I've been investing for over 30 years, my own money, and I share what I've learned during that time frame. Now, I want you to understand index funds they're just a type of mutual fund, really. They are a mutual fund in and of themselves. And they buy what's in an index. So you may have seen one of my other videos or read one of my blogs where I write about what an index is. But an index is simply a basket or a group of stocks with the commonality. You've probably heard of the S&P 500 or the Dow Jones. Those are indexes. So an index fund simply buys the things, the stocks or securities that are in that group, and that's what an index fund is. It is a type of mutual fund. However, most people call or think of mutual funds as being actively managed funds. So I think that a lot of people think, well, it's either an index fund or it's a mutual fund, and if it's a mutual fund, it's an actively managed fund. And that's okay. I'll explain that the difference between an index fund and an actively managed mutual fund is that with an active managed mutual fund, you've actually got a manager, or more typically these days, a group of managers that are actively selecting stock, just like you would be doing if you were a stock picker yourself. And they might even be going to visit the companies and doing extensive research on buying individual stocks. So that is a mutual fund that's actively managed versus just an index fund, which is, as I said, also a type of mutual fund most commonly. And there's another type of index fund called an ETF, but I won't get into that in this particular video. I will explain it in another video because there have been a lot of questions about that as well. So the difference between an index fund and an actively managed mutual fund, one thing is going to be, like I said, you have with an actively managed mutual fund, you have a manager or a group of managers picking stocks actively. So the fees are naturally going to be higher with an actively managed mutual fund simply because you've got to pay these people, these experts, these stock picking gurus to choose the securities that are going to be in the mutual fund. Then the next difference is that taxes are probably going to be higher with an actively managed fund simply because with an index fund, as you can imagine, there is a purchase of the securities that are in that index, and they're just bought and they're held for many years. There's rarely turnover in index funds, whereas with an actively managed mutual fund, you've got managers buying and selecting stocks, and they may decide, well, this was great 6 months ago, but it's not so great now. And so there's churn going on. There's buying and selling going on. Usually not that active. Some funds are very active, but usually not that active. And honestly, mutual funds that are actively managed, all mutual funds become so huge that it's hard for them to have a lot of turnover. That's another topic. Then one more thing I want to mention is that with an index fund versus an actively managed fund, you might have more diversification with an index fund. An actively managed mutual fund, especially if it's not huge, which is unusual, it may have fewer stocks than, say, the S&P 500. So you may have a little more diversification. That depends, of course, on which index is held and the specific mutual fund. Now, one thing I want to mention with an index fund, the performance can't be stellar because the index fund is the way that mutual fund performance and stock fund performance are measured. You may have seen my video on the benchmark and how that works, but an index is the foundation. It's the measuring tool. It's the benchmark for the performance of a stock fund. So it can't be stellar because it is the benchmark itself. On the other hand, an actively managed mutual fund can be stellar. Now, having said that, let me say that most index funds beat actively managed funds. That's right, you heard that right. Even though you've got a guru stock picker picking stocks, maybe even a team, more often than not, the actively managed fund does not perform as well as an index fund. Now, there are times that the actively managed funds do better than the index funds, but I won't go into that in this particular video. So if you like to research funds, if you like to research fund managers, that type of thing, maybe you don't want to buy and sell stocks yourself, but you want a little more action than an index fund, an actively managed fund might be for you. But in either case, investors' money is pooled and those funds are created. And just remember, with an index fund, there's not active management going on, and with an actively managed mutual fund, there is active management going on. But index funds are also mutual funds very often. That's what I wanted to share with you in this video. I hope that this is clear for you. If you like this video, please click like and let me know that you like it. Subscribe to my channel so that you don't miss any of my videos. I will be talking more about index funds versus ETFs and this whole concept, because it's so important for traditional investors to understand this now. And remember, always understand anything you're investing in and check the price before you buy any investment, always. Thanks.